Hi, everybody. My name is Janet Jones, and I'm going to be helping you in the second module on adjusting journal entries. So these videos and these modules are meant to help prepare you for the boot camp entrance exam, or if you're studying for the exit exam, and to just kind of walk you through the process from beginning to end on this accounting cycle. So this second module is based on adjusting journal entries. So what adjusting journal entries are basically accounting for some timing differences. So at the end of each month or quarter, we may have revenues or expenses that we've either paid or we expect to be paid for in the future, and we need to make some adjustments for those. So again, we have 4 different types, and our adjusting journal entries are going to fall into one of these 4 categories. So the first one is deferred revenues. So this is where we have received payment up front, but we haven't yet provided the goods or services, so we haven't yet earned those revenues. So that's deferred revenues, where we've received that advance payment, but we haven't yet kind of held up our end of the bargain. So deferred revenues will be recorded as a liability until we've actually earned them. So our example here is tickets sold for a future event. So if you're Taylor Swift and you are selling out your tickets in 30 seconds, but you're not performing those shows for another 6 months, all that revenue that you've generated for those ticket sales would be sitting as a liability on your balance sheet until you've performed that show, and then it will be transferred over into your revenue accounts. So at the end of every month or year or quarter, what we are going to want to do is analyze those revenue and liability accounts to make sure that all of our earned revenue is actually recorded as revenue, and any receipts that we've gotten for revenue or services or goods that we're going to perform in the future are recorded as a liability. So that's our deferred revenues. Then we could also have some accrued revenues. So if a deferred revenue, you got cash up front, but don't do the job until later, accrued revenue is the opposite, where we need to record some revenue that we've earned now, but we're not going to get paid for that until the future. So accrued revenues are revenues that have been earned. So we've already provided those goods or services, but we're not going to get paid for those until later, and we haven't yet recorded those on our books. So an example here is we could have some goods that we shipped out to a customer. Maybe we sent them out on December 31st, but we haven't had a chance yet to invoice that customer. So we haven't yet recorded those as revenues, but we've already sent out that inventory. So because that inventory was sent out on 12/31, we want to record that sale on 12/31. So we're going to need to add that revenue earned into that revenue account. So that's an accrued revenue. Then we could have deferred expenses. So a deferred expense, the cash is being paid up front, but we're not going to necessarily use that expense up front. It's going to give us some future benefits. So prepaid rent is an example of that. So if you pay 6 months of rent in advance, every month you're going to reclassify some of that prepaid rent as your asset into the expense category as we are using up that expense and using up that asset. So the treatment here is we want to transfer the expense that's been used up from that asset account into the expense. And then lastly, we have our accrued expenses. So accrued expenses are expenses that are recognized now, but we're not going to pay for them until later. So an expense that is recognized on the books before it has actually been paid or before we've received the bill for that business. So my example here is a utility bill. So we may be using water every single day, but we don't get the bill until the next month. So at the end of the year or the end of the month, we're going to want to make sure we are recording that expense for when we actually used that water or that electricity. So we'll want to add that expense in that has been incurred, but we have not yet received the bill for those. So these are our 4 different classifications of adjusting journal entries. So what I would like to do now is walk through that reconciliations are us example you did with Dr. Ross in the first module, and show you or highlight the various adjusting journal entries that we would need to make, and then go through the full process. So I'm going to switch over to my Excel document and we'll go through that. Okay, so here are the transactions that you would have done in this reconciliations are us example, and I've highlighted these four. So in the first one, we have a 1-year lease that has monthly rent of $1,000, and the lease requires the first 3 months to be paid up front. So that would be an example of that prepaid asset where we are paying for that expense up front, but we're not going to recognize that expense until later. So this is an example of a deferred expense. So we're going to need to record that we've used up some of that rent in the first month of operations. The second one, we have a computer that costs $2,000, and then we have the estimated useful life with no salvage value. So you probably remember about depreciation. So depreciation is where we are paying for that expense up front, and then we have to write it off through a depreciation. So again, this is another example of a deferred expense. So we'll record that depreciation to reflect that she has used up some of the life of that computer. Then we have office supplies. So again, this is paying for something up front and then using it down the line. So we aren't told how much supplies we would have left. So let's just add something here. So I've added down here at the bottom that Amy looks in her supply closet and sees that she has $250 worth of supplies remaining. So in the beginning, she had purchased $750, and now she's used up $500 worth and only has $250 remaining. So again, this is another deferred expense where we're going to have to reflect that she has used up $250 worth of supplies. And then the last one, another example of a deferred expense, she paid for a annual subscription of $1,500, and she is using up part of that subscription. So we would have to reflect that as well. So we have a number of these that we are going to reflect on our journal entries. So I'm going to go over to my journal entry tab. And you should have already completed all of these journal entries. So now I'm just going to go down to the bottom and we're going to do our adjusting entries. So for this first one, we have that 1-year lease. We paid 3 months up front. If we look at our T accounts, we see prepaid rent of $3,000. But we're in the end of the first month, so we're using up $1,000 of that. So we paid for 3 months. We need to record that we've used 1 month up. So we're going to do that with a debit to our expense. So 501 on 331 of X5. And DEDCLOR is the little acronym to remember that DEAD, debits are our expenses, assets, and dividends. So because we have an expense that is increasing, we want to debit that. So we have our rent expense for $1,000, and then we have account number 104, which is the prepaid rent account for $1,000. So this journal entry is just to record used up rent that was previously recorded as a revenue. So now what I'm going to do is go over and post that entry. So I'm going to go over to my T account. So this is what you should have had at the end of number 1 of module number 1. And we're starting by using up $1,000 of that expense. So we had that prepaid expense. We're using 1,000 up. So now we have 2,000 left, 2 more months of prepaid. Now we're going to want to record that expense. So we have $1,000 recorded in that expense, showing that we've used up $1,000 or paid $1,000, incurred $1,000 worth of expense. Now we'll go to the second one. So the second one told us that we had a computer that cost $2,000, no salvage value, useful life of $500. So 5-year useful life 5 times 12 is 60 months. So we're going to need to deduct 1/60th of the cost of that computer because we've used up 1/60th of its use. So we'll again start with debiting our expense. We are talking about depreciation here. So depreciation is the expense that we're going to want to use, and 505 was that number. So we will start with that debit to depreciation expense. Depreciation expense. And then our credit is going to go to that accumulated depreciation, which is the contra asset, meaning it's going to have a natural credit balance. So again, we are going to have $2,000 as the cost. There's no salvage value. So typically it would be the cost minus the salvage value and divide that total by the useful life. So our useful life in this case is 60. We're using 1/60th. So every month we're going to record $33 worth of expense. To record depreciation expense on computer. Okay, so that's number 2. Number 3 then were those office supplies. So she had purchased $750 worth of supplies. At the end of the month, she had $258 left. So that tells us she used up $500 worth of supplies. So our supply expense account is 506. It wasn't on our chart of accounts, so I just added it. So it's our newest expense there, 506. So we will add 506 on 331 for supply expense. And then our credit is going to go to our supply inventory. So 103, supply inventory. And we are recording up used up supplies. So the supply inventory is currently sitting there with an asset balance, a debit of $750. We need to bring that down to $250. So we will do that with a credit. And then the alternative side, we'll want to put that $500 into that expense. I forgot to post depreciation, so let's post both of these now. So we're going to go over to our T accounts and we are going to look at our assets. So we have that $2,000 computer sitting in our property, plant, and equipment. And then we have this alternative or the contra asset account, which is where we will record that depreciation. So it's $33. So this tells us the carrying value of this asset is going to be the cost minus that accumulated depreciation. So we have $1,967 left of useful life or useful value of that computer that will systematically get written off over the next 3 years. The alternative, the other side of that is the expense. So we want to go down to our depreciation expense and put that $33 here. We have our credit check to make sure our debits and credits match, and we are good to go. Now, the last piece is the expense of those supplies. So right now we have $750 sitting there for the supplies. We know at the end of the month we have $250 left, so we need that credit of $500. I'm going to pause the video right now and add in that account for my supply. So I've added in the supply expense account, but we see that our debits and credits are now out of balance because I've only recorded one side and I haven't recorded the other. So we see that it's off by that $500. So I'm going to put in that supply expense of $500 and we see now that we are in balance. Okay, last adjusting entry that we're going to talk about today is the software expense. So the last one said we had paid $1,500 for the annual subscription of software. So again, we have used 1 month of that annual subscription. So our accounts here are 503 for the software expense. And then we will have account number 105, which is that prepaid asset. So we have the prepaid subscription where we had recorded the 1-year subscription of that software. So to record used up subscription. Okay, so we have $1,500 is the total of that annual subscription. So that is for 12 months. So that's $125 per month. And we've only used up 1 month of that subscription. So that's the only month that we need to record. So going into our T accounts again, we need to record that subscription expense as well as the reduction in that prepaid asset. So we have this prepaid subscriptions with the total amount for the year, but we're using up 1 month. So we have 11 months left to be used, and we are using up 1 month. And then when we go down, we can record that expense, and we are putting in that 1 month expense. So I'm going to stop the video here. If you need to get caught up, please do so. And then now that we have done the journal entries and the T accounts, the next thing will be to create the trial balance. And then we will go on and do the financial statements.